have Joe calling from Montreal. What's your question, Joe?
Hi, I have an interpipeline in my cash account, and I wanted your short and medium-term prospect for the company and for the dividend growth and safety. Thank you.
Sure. Dividend's almost 7% now.
Yeah, it's a great yielder, Joe. I believe it's in the wrong group, so it's having a nice bounce based on the association with the energy patch, and I think that that's good. The sort of long-term moving averages are moving lower, so it's kind of going against the grain right now. I would probably suggest to you it might be an opportunity to actually reduce your stake a little bit, but you're going to get paid your dividend distribution, and it's going to grow a little over time, but it is dependent on what's going on in the oil sands, and it's going to be dependent on volumes there. So they will grow a little, and you'll get a little dividend growth. It just may underperform the market. Now, that doesn't mean it's not an investment to have, because you may not want economic sensitivity. You may be looking for just a dependable dividend. I just think that you could see the price be a little bit soggy if we are in the kind of market I believe that we are, where people are more in search of companies that benefit from a strengthening economy.
We have Ron in Carp, Ontario. What's your question, Ron?
I wonder if you could give me your views on the steel industry in the United States in general and U.S. steel in particular. And Greg, the next time you see George in the hallway, tell him I think you should get a raise.
Which George? You mean the big man himself?
You're the big man, CEO.
Right up to the top. Okay, I'll let him know. Thanks, Ron.
So, Ron, going back to first principles, we look for structural themes in the economy. CEO optimism has been steadily improving in the U.S. I may not agree with President Trump's social beliefs, but his business beliefs are probably more constructive for business and capital spending in the U.S. going forward. The steel group as a sector is behaving quite well. I actually own in our macro fund some exposure to the SLX, which is the steel producing ETF, and it's basically at a relative new high versus the market. So U.S. steel is certainly one that you could take a look at. It's behaving pretty well. And there's others in the group, but I think that if you're looking for one of the leadership groups, this is leadership in U.S. equity market.
Murray's on the line from Montreal. What's your question, Murray?
Mark, I'm currently holding about 5,000 shares of it that I bought at a lower cost, probably around $70, and obviously watched it go to 100 and now back to 87. So I just wanted your opinion if I should accumulate a little bit more here at this 87 level, and what's your outlook on it going forward?
All right, that was Murray asking about Walmart.
Okay, Murray, on Walmart, let's first of all talk retailing. Retailers are behaving pretty well. The breadth or the percentage of retailers that are in long-term uptrends has been expanding. It's one of three key consumer discretionary groups that are participating in this rally: retailing, apparel, and travel and leisure. We like all three, and we own companies in all three areas. I'm going to be a little controversial and say, why don't you pair your Walmart position with a complementary position in Amazon?
Yeah, if these are the two behemoths that are going to go after each other, is that a sort of way of just?
I mean, listen, if Walmart can be successful in online, they can maybe become a competitor to Amazon. I think it's a tall order, but I think that they both dominate retail together. I like the sector. I would consider doing that.
All right, Stanley on the line from Kingston. What's your question?
Hi, thank you for taking my call, David. My question is on a safe, ultra-safe dividend stock, whether it be BCE or TD Bank. What do you think for someone who's retired and wants a good, safe, stable dividend that won't be cut, and there's still some upside left to the stock? I was thinking TD Bank, BCE, or whatever else you could suggest for now and for the next, I guess, 5 or 6 years. Thank you.
Wants a safe income stream, but also a little appreciation in the stock price.
Yeah.
I know the telecoms have been under pressure this year.
Yeah, I'm cautious on telecom as a sector, and I'm cautious, no offense to anybody, on BCE as one of the participants in the group. They still have a lot of wireline exposure. So I would probably stay away from BCE. If you go to the financials, I do like the financials. The only Canadian bank we own is TD, and we have reduced it a little bit. And it's not because we don't think the dividend's safe. Dividend's safe. They've got great U.S. market exposure, which is why we own it. But frankly, if given a free rein, I probably would steer you towards one of the U.S. banks, because if you're going to get a lower dividend, but I think you're going to get much higher dividend growth. And we are coming up to the period during the year where the Fed does their tests on stability, and they will give the U.S. banks the opportunity to raise dividends, buy back shares. Bank of America will be a big participant in that. But, you know, TD would be a good one. I just would prefer the U.S. banks a little bit more because the U.S. economy is just a little stronger.
All right. Need to remind the viewers at home, of course, that BCE, ultimately our parent company here at BNN through the Bell Media division. We're going to be back with David Burrows. He's President and Chief Investment Strategist at Barometer Capital Management. To answer your questions about North American large caps, so call us toll free, 1-855-326-6266.